Good weekend, all. Ira Epstein with your agriculture update, and this is your weekend edition for Friday, and we're September 13th, 2019. So this was your pork and bean week. In other words, China and the U.S. for the moment have decided to step back from that line where it was tit for tat arguing, and instead China's decided they're going to buy some pork, they're going to buy some beans from the U.S. The U.S. is discussing maybe, just maybe, you got to take these small steps to get to the end game, and it's having an impact on everything. We had a series of what we'll call crowded trades. You don't know they're crowded until after the fact, unfortunately, but look at silver. This was a $19 market. It's now $17.50. The gold market was just up about $50, $60 higher. It's come down. I'll tell you the market that's really added, yields. Gone crazy, in other words. We were just pushing 1.4 in the 10-year. Now we're pushing high 1.8 in a fraction. Stock market. This is the market that, while it gets breaks every now and then, they come back like that at you. And what is this? 8 days in a row up in the Dow. But the real story is what's been going on in the grain market. So let's take a look. And remember, on the weekend edition, we look first at one monthly chart, and then we're going to go through a series of weekly charts to get the weekly picture. The first thing, we haven't been over an 18-month moving average of closes, which is the red line, and that number comes in at 890.75 since back here in 2018. Is this where it's going to happen? We finished at 884.75 for the week, and that number's let's call it 891 to just round it out. And again, this is just closing basis, but that means we're coming into a resistance area that we should be looking at. When you take a look at a weekly bar chart with no studies at all on it, the market came down and this 840 area became an important zone. You know, it's nice to look back. You can see that you're rallying up, but you've got resistance here in the 920 area. And as we just said, that 891 zone, we can see that on the monthly chart. That's going to be important. When we look at swing lines, which a swing line is how you draw a line from the previous bar on a chart. Let me explain that. You'll hear often on financial TV, if you're bullish, you're looking for higher highs, higher lows to be a bull market. In a bear market, you're looking for lower highs, lower lows. When you have a market that's doing nothing, it'll typically have in some sequence a higher high and a lower low that expand the range out, going like that. Well, you don't have that here. You've got a pattern of higher lows and a higher high. That is bullish. The market is trading over the 18-week moving average of closes. The importance of that is chartists like to have a reference point. And if a market's over a certain number, they're going to say the bias is up or the bias is down. I believe that you can use the 18-week moving average as one of those numbers. Where's resistance? Well, one of the numbers of importance is the 100-week moving average of closes, and we've been under it since May of a year ago. So that's fairly important. So the resistance, 918, which ties right back when we were looking here and just talking about this 920 area, right? Bollinger Bands, these black lines. What a Bollinger Band is an algorithm designed to keep the market trading within it 95% of the time. Therefore, we're getting together an idea here that the 100 and the 100-week moving average of closes and the upper Bollinger Band, they're coming together in that 918, 920 area. So if the market were to pop, I'd be prepared to say 891 important on the monthly chart, and then up to the 920 area, next importance. You break this pattern if you get back under this week's low, which was 839.75, and the market might want to keep hitting as it's been doing. Are you noticing how often this market's been hitting the 18-week average? So if you pulled back, I'd be expecting 870.5 to be important. In momentum, momentum had been coming down. You can see how the market was working itself lower. Now the momentum has stopped coming down, and the question is it going to start pointing up? Hasn't done it yet. It's neutralized itself at this point. In the meal market, the market this week got to a high of 299.30. I actually should have this number pointing up. That just didn't look right to me. We actually have a lower high and a lower low and a higher high. This week's high took out 298.30. That's neutral. The market had been pointing down, and you can see this right through here, and it never did reach the lower Bollinger Band, and instead it's paused. It has not turned itself back up. You need to get that red number over the 20, but a steady to higher opening Sunday night could be the beginning of that. When we look at soybean oil, we've had a pattern of higher lows, higher highs, and the market keeps holding what I call that line in the sand. Remember we talked about bias just about a minute ago. Well, it keeps pulling back to that 18-week average, finding support. If it can go up from here, I look for the combination of 29.48, the upper Bollinger Band, to the 100-week average to be important. Because this was an outside week up where you took out the low and the high of the previous week, I think this week's low is important. In fact, if we come back to meal, let me come back this way. You had an outside week up, so I think it's important here. And in the beans, you had outside weeks up. So in the bean complex, the market had come out, made lower lows than the previous week, and then turned itself back up. In the corn market, not quite that pattern. But corn has had one heck of a ride to the downside, and just maybe this, if you will, $1.30 break. And yeah, you had been up here in this 470 area, back down into the 340 area, and you're finally getting a bounce. I don't know that it's more than that. I can tell you momentum hasn't turned as measured by the slow stochastic. It's overall still down. The market's got a pattern of lower highs, lower lows. It doesn't seem to want to reach the Bollinger Band. If it doesn't, if it rallies, where do you think the first resistance point might be? I would argue it could be this 100-week average. If it gets all the way through there, maybe it gets back to the $4 mark. But I would think farmers would be thrilled at harvest time to see $4. In the wheat market, you ended a downtrend. Now let me explain that. You had clear patterns of lower highs, lower lows. Notice how on this rally, the market tried to hit that 100-week average. That's similar to what we're just looking in corn. The market did not reach down for the lower Bollinger Band, and if it were to take out the high right here, and that high was this week's high of 480, I'd be cautious. Markets that take out the high of an outside week down within 2 bars, and each week is a bar here, so this counts as the first week, but you came back up through it, often spells a pause. The market is through doing a move. Now, the first resistance, in all fairness, was the 100-week average, which you're at. The next one is the 18-week average. It's not bullish, but I say it ended this downtrend in the market. In the cocoa market, we have a market that's got a swing line pointing up with higher lows, higher highs, but the bias is down since you're under the 18-week average. Now, when you're down here and you've got this pattern developing, the first resistance is often the closest of the key moving averages, which in this case is the 100-week. And if you get through that, then you're looking for the potential of the 18-week. Again, momentum was flattened out. It had been pointing down and it started going flat. The market itself turned up. Now momentum is up. You went up past that 100-day average, but you didn't get too far past it. Next resistance, 23.67, the 18-week moving average of closes. Like the wheat market, this market ended a bear cycle of lower highs, lower lows. Do you see that right through here, these? And changed the pattern on the chart this week. Important. In the sugar market, you're still very much in the bear pattern. You have lower highs, lower lows. Now, one of the things I teach is you don't sell underneath Bollinger Bands. If you do and you go back on your charts, how often when you're under them do you get the market to sting you? So it's doing that, so I wouldn't be surprised to get a rally. But a rally is very different than changing the overall trend of the market, which is to the bear side at this point. In the coffee market this week, a big important week, a lot of the soft commodities and so on changed or left bear trends, one of the two. You've had lower highs, you had lower lows. You see that to there. Momentum had been pointing down. If you take out 94.85, you could break that pattern if you don't get down through this low that I'm pointing you to, which would have been, in this case, 89.60. The market didn't do that. Instead, it came up, closed over the 18-week average. So suddenly, the coffee market has broken its downtrend, and it's been in a heck of a run here. As you can see, it was a 125 market. It got down into the neighborhood of 90, and it's coming back up. I'm sure Starbucks will use this little bit of a rally to raise the price when you go in there. I gave up on those $5 coffees a long time ago. In the cotton market, cotton's got lower low, higher high, downtrend over. Again, let me point this out. You tell me that if you believe in the definition, lower highs, lower lows, if you get through right here, 60-12, you break the pattern, and what I call the line in the sand, that 18-week average is often the first resistance. Yes, it can be a 100-day, but this is the most important line to me. It's what I define bias from. So the trend is broken. The bias is down, but you went back to a neutral point, momentum turning up on you. In the cattle market, you had gotten under the Bollinger Band. And one of the things I teach is, yeah, you can get under it, but it depends from what kind of pattern. This was at least a narrow Bollinger Band. It's pretty wide out here. You got under it, and you're getting a bounce back into it. It's not a trend change. You're getting a bounce into it. Momentum hasn't turned up, bias still down. In the hog market, we know what's going on. Suddenly, China is buying. So for the week, you were up only 3 cents in the lead option. Now, the D's hogs, I'm talking on the daily chart, has gone up the past 2 sessions alone 750 points. That's a major move in itself. This market's first resistance is the 100-week average. After that, the 18-week. More important to me is if you take out the 6,800 level, you will have broken the pattern of lower highs, lower lows, and you end another phase in the market. We'll see if it can do it come Monday morning, but that's where this market is. You know, what I try to do each morning for my subscribers is I try to help them stop guessing themselves in what I put out each morning. And it is not meant for just that day. I am telling you, if a market gets to a certain level, come out. If it gets to a level, come into the market. I'm trying to give you ideas as I'm seeing them. The charts will look very different. Try to imagine you're sitting next to me. And we're reviewing a chart, and I'm putting out a few more studies, and we're going to review together 40 charts on the futures, 5 typically on the ETFs. And the ETFs will be the major ones like on oil, TLT. We're going to go through the VIX. We're going to go through a lot of things. VIX isn't an ETF, but you're getting the point. In that, I'm going to tell you, buy here, sell there. Here's where I think you'd be wrong on that trade. Here would be a moving stop for it, and here's an objective in the market, be it on the upside or downside. That's how your day is going to begin. I get up, first thing I'm doing is reading Asian news, then I'm reading what's going on in Europe, then I come back to America, what has happened since I went to bed and where we're at, and what are the reports coming out in the morning. So my idea there is to go through these charts in a certain sequence so that you can jump to where you want to be. You can watch the whole thing, but you don't have to. I record it all as one video, and I'm going to review in each time this exact sequence. And then typically on the bottom, you're going to see a slide bar. As you slide it, foreign currencies will pop up lighting for you, meat markets, energies. I'm just saying where you'd be. There'll also be a lexicon on the side so you can quickly see what it is. Some people look at these a couple of times a day. They'll look, what did he say on that? And they'll come back to it. I can do a lot more in a video than I can do in just writing, but it's the combination of what I write for my overview of the market along with this, which I think gives you the tools. Now, if you just want the video, and I recommend that you start somewhere, it is all of 26.5 cents a day to get you going for the first 30 days, $7.95. After that, it becomes $15 if you want to stay with it, or you can move to the equivalent of $13 every 30 days by paying a year up front for $156. Think about it. Silver market today down 50 cents. That would be 3 cents for the whole year, right? One penny in silver is $50. That would pay for almost 6 months of my service. So I don't think I'm too far off. And if you look at corn, $50 a penny, you're getting the point. That's what we do. To find out more, simply go to our website under the word education or research, Ira subscriber video, or you can click right up here. You can subscribe right on the website. You'll be activated, well, with this come Monday morning. You have yourself a good one. I'll see you come Monday.